I'm sure you've seen a lot of YouTube videos online promising you to get rich fast, retire early, and live off of dividends forever. But I find that some of these portfolios, it really takes decades to build sufficient capital for withdrawal, and the main focus is not creating immediate income. And if it is, it's not sustainable income. And so you worry, or at least I did, that it may not be something that I can rely on in the future. So I created my own strategic portfolio that combines the power of SCHD with three complementary ETFs, provides reliable income and keeps up with inflation, offers diversification and preserves capital, and it's given me the ability to live off investments now. So if you're interested to see what my portfolio looks like, stay tuned. Okay, so this is part of the SCHD Freedom Series, Episode 1, and I'll be talking about how I'm using SCHD as the core and three ETFs as complementary ETFs to help bolster or boost income. And I use this portfolio to quit my 9 to 5 job. Now, to give you a little preview, I'll briefly talk about the role of SCHD. I won't go into every detail of SCHD, but just things that make sense to me and why they're in my portfolio, or why SCHD is in my portfolio. And then I'll talk a little bit about the three ETFs. And again, I won't cover everything in this first episode. I hope to leave some information and some updates for future episodes. And then I'll talk a little bit about the income breakdown and how much I'm making from this portfolio. So, starting with SCHD, you can see that in the last 10 years or so, it's done pretty well. I mean, it's not the same type of chart you'd see from other ETFs, but for me, I'm reasonably happy. And if we look at the portfolio construction, we can see that after the rebalancing, or reconstitution, energy is a big part of the portfolio. But we can also see that technology is not. So, any portfolio that has technology is probably going to outperform SCHD in terms of capital appreciation. The only way I see SCHD outperforming in terms of capital appreciation is if they get something like Broadcom back into their portfolio. But again, I'm not holding SCHD because of its capital appreciation. If I wanted to, I would probably just invest my money into the S&P 500. But why I invest in SCHD as a main part of my portfolio is for its safety and durability. You can see that in the worst year, SCHD was only down about 5.5% compared to degrow almost 8% and S&P 500 18%. So moving on to dividend growth, I think for most people invested in SCHD, that's why they're in it, is for its growth. Now I've chosen modest numbers, about 9% for the last 5 years, and probably not as great as some other recent ETFs, but I think it's still pretty good. And when we look at this chart, it is scheduled to increase every year. Now, if you believe in the rule of 72 and compounding interest, you'll know that the dividends, or the dividend growth will double about 6 to 7 years. So if it's 26 to 27 cents now, it's probably going to be double that in 6 or 7 years. But I think the real power, or at least to me, is the yield on cost. And I think I really didn't understand what dividend growth was until I understood yield on cost. So if we look at the next chart, we can see that next year, if you hold your shares and your average price is under $27, then your yield on cost is probably going to be close to 4.5%. Now, what's amazing about this is if you hold those same shares, the yield on cost is going to be about 7.5%. I think that's amazing. Now, to blow your mind further, if you hold your shares until 2035, the yield on cost is going to be close to 14%. I mean, that's better than SPYI, some business development companies, and pretty close to QQQI. And I think that's one of the reasons why dollar cost averaging hurts people's portfolios because it affects the yield on cost. And I'll talk about that in a future video. But just looking at this yield on cost, I think that's one of the reasons why SCHD shines in the long term and not the short term. Okay, so far I've talked about some things that I like, but the thing that I really like is the qualified dividends. Now, if I show you a quick chart about qualified dividend income or QDI, and we go to SCHH, which is a REIT, you can see that the qualified dividend is only at 1.68%. And the reason why is because REITs generally are not qualified dividends. Now, if we look one row down to SCHF, we can see that the QDI is about 85%. And the reason why is generally a lot of international funds are not qualified. But if we look at SCHD, it's 100% qualified. And why is that important to someone like me? Well, if you make under $50,000 in qualified dividends, it's tax free, right? And I think that's important to me because in some countries, if you live overseas, they don't have a double tax agreement. So you have to pay tax twice. And I think if you're generating a lot of income and some of it's non qualified, you definitely want to take advantage of any qualified income you do have. And so I think one reason why a lot of people do have SCHD is the qualified dividend income. Now, if we look at some other recently popular ETFs, you've seen a lot of videos how, oh, FDVV and CGDV are outperforming SCHD. And that's correct. They have tech and they have some securities that just have a sort of faster dividend growth rate or just faster capital appreciation rate. But what they lack or underperform in terms of, you know, qualified dividends, look at FDVV, 75.25%. And CGDV, I couldn't find a published chart, but I estimated it's about 90%. And, when I look at the prospectus and the website or information from the website, you can see that non-US equities is about 6.7%. Remember, a lot of international funds are not qualified. And if we look at their asset mix, you can see that they have two REITs, and REITs are not qualified dividends either. So I estimated about 90%. It could be more, it could be a little bit less, but the bottom line is it's not 100%. So if you own a lot of CGDV or FDVV, you're not going to have some of those same advantages as you would owning SCHD. Okay, so that was just a brief overview of SCHD. And the reason why I did that was because if you see some videos online, they don't really talk about the qualified dividend part and the yield on cost. They just talk about capital appreciation and dividend growth. And for me, I think the last two parts sort of help anchor the portfolio. And the main purpose of SCHD is to provide stable income, growing income, and a chance for that income to help me retire in the future. Now, if we look at the complementary ETFs, I've organized them by theme, and then the next slide I'll tell you which ETFs I've chosen. So the first theme is large cap cash flow, and some examples would be OMAH and SPYI. Tech powered income, and that's about 10% of the portfolio, and that could include something like AIPI or QQQI, and then small cap opportunity. And it doesn't have to be small cap, but I chose this as a way to diversify how income is created. And I think something like RDTE or IWMI could offer some potential income that the other two funds don't. Now, if I look closer into detail, I chose OMAH, and it's from Visa Shares, and they're paying about a 15% annualized rate of return, or yield on dividend. Well, do they call it dividend? It's more of a distribution. But it mirrors 20 of the largest holdings of Berkshire Hathaway, and it runs a covered call strategy. And the ideal is to pay close to 1.25% monthly. Nothing more, nothing less. They just want to hit that 15% annualized rate. I think this is really good, and it's a bigger part of my portfolio. Not as big as SCHD, but it's there to kind of mitigate risk, provide stability, and provide some, income cash flow. Now, AIPI by Rec Shares is, of course, tech powered, and it owns 25 AI equities and runs a covered call strategy. It also pays out monthly. Now, if you look at the distribution rate, which is about 34%, it ranges from 34 to 39. And I think that's a really good number. For me, that's a really important part for income production. I find that anything under 20%, you have to have a lot of shares in order to live off of it. Okay. Now, if we look at RDTE, it's different than OMAH and AIPI because they actually don't run their option strategy on shares that they own. It's a synthetic exposure to the Russell 2000. Okay, so it's a little bit more risky than AIPAI and OMAH, but it still offers about 34%, and it's running an option strategy on an index, which I think is safer than running a call strategy on an individual stock. So I chose this as a way to, you know, some risk, but I think there's a potential for a lot of reward here. And what I really like about this fund is it pays out weekly. Now, in terms of compound interest, there's not such a big difference between monthly payout and weekly payout. But why do I have this in my portfolio? Sometimes it's hard to budget when you're only getting paid once a month. So if you get paid weekly, sometimes you might get caught surprise with a fund or sorry, an expense, or you need to do something but you can't wait until the end of the month. So having a weekly payout can kind of help you budget a little bit easier. I mean, that's what it's done for me. Now, speaking of things that come up, if you ever heard of that phrase, everyone has a plan until they get punched, I think that's definitely true. And it's really true in the stock market. There's a lot of ups and there's a lot of downs. So part of this portfolio, which makes up about 5%, I call this the enhanced capital preservation part. Now, I'm not going to go into too much detail because that's beyond the scope of this video, but ideally, it's sort of a cash reserve. So if you want to buy something that's on discount, let's say there's a down market or downturn or some black swan event, then the cash from this can help you buy those shares. Also, sometimes you'll make or you'll receive dividends and distributions, but you're not exactly sure what to do with it. But you don't want to just leave it idle. So having it in any one of these funds, it will actually be a productive way to keep cash, but have something on it. 3 to 4 to 5% is not a lot of money, but it's better than nothing. Um, and I think it's also really good to just have sort of rainy day money. You never know when something happens, and especially if you're living overseas, you don't want to sell your stock in order to, pay for something. So having 5% of your portfolio in this, for me, has just been a really safe part of this portfolio. Now, I personally am in SNSXX, but I know a lot of people are in SGov and HYBI. So I've put the names of YouTubers at the bottom. The Dividend Capitalist, Eugene, did a recent video on SGov, and he talks about his strategy for using SGov in his portfolio. HYBI, I'm sure if you're in the investment space, you've heard of armchair income. and he interviewed a person from Neos, and he talks about HYBI. And finally, I forgot Diamond Nest Egg. She covers a lot of stuff on treasury bills and bonds, so she's a good resource to look for more information about money market funds. Okay, so I think most of you have been waiting for this part of the video, which is the portfolio income breakdown. Now, this portfolio yields anywhere between $3,500 to $4,500, just depends on the market. Now, the first two parts are the core holdings, and they are meant to appreciate in value. So, although my portfolio, I'm generating current income, I'm hoping that these two parts or these two components are going to help my portfolio keep growing in terms of capital and dividend and be something that I can rely on in the next 5, 10, 20 years. Okay. So you can see the SCHD right now. It's about $450 a month, but it's paid quarterly. So it's actually three times that. And it's not actually enough to live off of. But my bet is that in the next 5 or 10 years, it will be. Okay. Now for the next part, AIPI, RDTE, these are riskier bets or investments. And that's why they're only at 10% each of the portfolio or 1/5. But they pay $1,000, about $1,000 a month. And sometimes they pay even more depending on if the distribution is 34%, 35, 38, 39. Okay, but these are slightly riskier, so they're a smaller part of their portfolio. Now, I told you before I have SNSXX. It's not really meant to be an income generating fund. It's sort of just rainy day emergency money, and it's 5% of the portfolio. Now, I call this portfolio SOAR, and ideally it covers all of my expenses without having to sell shares. It produces growing income that outpaces inflation. It gives me the ability to have true freedom and do things on my own term. And I think one of the most underrated parts of a portfolio is capital preservation and capital security. I can go to sleep and not have to worry about this portfolio crashing. Now, this portfolio is not some back testing video, it's not theory. I'm actually already living off of this portfolio and I'm still building it, which means it's not complete. It has a sort of framework, but it's not 100% built up. My SCHD, I still would like more shares. Um, my OMAH, I still love more shares. So it's still a portfolio in progress and I'm still making tweaks. But let me share you some insights and final thoughts. So, as it stands right now, this SOAR portfolio would not be enough for me to live in America. I'd probably need a part time job or do some freelance projects. And I think this could be something for like a semi retired version of me. So, I think this is something that um, could be good for those that type of situation. What I really use it for is the geographical arbitrage. Like I said, it's not enough to be in America, but I live in Asia and it's more than enough, especially because rent is not so expensive and the standard of living is quite low. So if you live overseas, a portfolio like this could work. Also, if your time of horizon for other supplementary income, such as your Roth IRA or your Social Security, is coming into play, I think that's a pretty good pair. And for me, I'm still quite a bit of far. I'm far away from that, but I can rely that okay. I think this portfolio can take me there, and then to Social Security. So I'll have three forms or three streams of income coming in. Okay, so I think this SOAR portfolio works in a lot of situations and it's worked for me so far. So I don't want to make this video too long. I would love to update everyone on in future episodes on how this SOAR portfolio um, is changing, is growing, how I'm tweaking it, how much income I'm making. and answer any questions you have in the comments. So again, thank you very much for your time, for watching this video and spending some of your valuable time learning about how I'm using SCHD. So take care of yourself and see you in the next video. And remember, this is not financial advice. I'm just sharing something that I'm doing, and it may inspire you to do something great and do more research for your portfolio. Thank you very much. Take care.